faculty director for the Center for Business Analytics, and this event is part of our Practitioner series. One of the things we do in the center is to try and bring students and faculty and together with practitioners and learn about things that are cutting edge, and I think today falls definitely into that category. So we're happy to have Susan Ramonat here today to talk about blockchain. So I was just mentioning that I was on vacation over the break, and I was in a bar, and there was a group of students that were your age, and this conversation kind of ended up about, we started talking about cryptocurrency and blockchain, and I was just amazed at how much the kids, there was 8 of them, and they were from like University of Miami and a couple other places, just how into it they were. And so happy to have all of you here to talk about something that is very timely and relevant. So welcome, Susan.
Thank you. Thank you, everyone, on Friday afternoon. This is impressive. You're making me think of the conversation I had with my son 3.5 years ago when he was still in university. I said, do you have any friends that do this Bitcoin mining? And he said, yeah, they're kind of geeky. And 3.5 years ago. And I have, over the course of the last 3.5 years, been on a journey myself in the world of Bitcoin and blockchain. But it's interesting how it has now become part of the conversation globally. And certainly when you say Bitcoin now, people think they know what you're talking about. They certainly have a point of view, and there's certainly a lot going on. Hopefully what I'm part today is more about the underlying technology in terms of the origins, roots of Bitcoin and blockchain, some of the fundamental principles and the disruptive potential that's created so much energy beyond cryptocurrencies and the speculation there. The communities that have come together, who the major players are, how to think about use cases in various sectors of society and business, some of the challenges that exist, and as well talk about what we're doing at Spiritus. You may be able to tell from my accent that I am from somewhere between Philadelphia and New York. I grew up in Bethlehem and spent most of my life outside of Philadelphia. I'm now in Scotland. We have cited our business there, largely with the benefit of grants from the Scottish government to hire talent there, as well to work with the National Health Service and some of the industry players there at major universities. So usually I have to apologize for my accent and say that speech therapy is available, but you can trust that Scottish is not a language that's easily understood either, so it's a two-way street. Who recognizes this? Anyone recognize this? Yes?
It was the date Satoshi Nakamoto published his paper.
Close. It was actually the date that the first block was mined. Folks know what a block is? What mining is? You heard those terms associated with Bitcoin and blockchain? Yes, Satoshi Nakamoto, an anonymous person or persons, published a paper called Electronic Peer-to-Peer Cash. It's about a 6-pager. I commend you to read it. And it was fundamentally a breakthrough in the sense that it brought together well-understood principles around cryptography and software with insights around distributed systems. It was the intersection of those three, insights about cryptography, software, and distributed systems, that was the unique foundation on which Bitcoin was founded. But whomever that is, and then Satoshi Nakamoto arguably has not come forward yet, there was an underlying concern and message. And there was actually a text message that accompanied the block. This is from the Times of London. So recognize that Shearson Lehman Brothers had failed, or nearly failed. Yes, it did fail. In September of 2008, and here we are a few months later in the text message accompanying the first Bitcoin block, the Chancellor, the UK Chancellor of the Exchequer, on the brink of a second bailout for banks, Royal Bank of Scotland, Northern Bank, Northern Rock. So there was a larger ideological agenda and statement associated with disintermediating banking institutions. Anyone recognize this? First of all, what's a DAC? Anyone recognize this? A DAC is a decentralized autonomous corporation. And that date's not right. It should be 2011. And the statement that was made in this paper was, can we remove management from the equation? We're not just talking about disintermediating banking institutions. In this case, the author and some of his co-founders of what we now know as the Ethereum Foundation suggested that management and intermediaries would no longer be necessary, that transactions across all aspects of our lives could be mediated by computer and distributed consensus and distributed systems. So Satoshi Nakamoto and Vitalik Buterin of the Ethereum community have set forth what some would argue is a broader revolution. So beyond cryptocurrencies and the fun and speculation and potential disasters that go with throwing your money at an explosive bubble, there is a profound statement being made by many in the communities, the contributors of open source code to the Bitcoin and Ethereum communities, to disintermediate the institutions of society that they feel have failed us here in the West and in the developing world, failed citizens in developing countries and emerging countries. So if you look across the spectrum in the landscape, you will see a whole range of suggestions about what this might do. But let's step back and talk about the fundamental concept brought forward by Satoshi Nakamoto, which underlies Ethereum and also underlies what we'll call private or permission blockchains or ledgers. The steps in a blockchain transaction. This was done by Standard Chartered a couple of years ago. I think it is the best simple representation graphically. So what you see there are two parties agreeing to conduct a transaction. They exchange and assign cryptographic keys to the transaction. Is there such a thing as a Bitcoin? Just to be clear. Does anyone know? Can you take it out of your pocket? Can you take it out of that virtual wallet? It's actually just key pairs. There are no Bitcoins, and people have Bitcoins stolen. It's their key pairs. They're keys. They're private keys. It's a very difficult concept to understand, that parties can agree through these cryptographic keys that a transaction has occurred. That transaction is broadcast across a network of nodes who perform, in the case of Bitcoin and Ethereum today, what's known as mining. Very difficult mathematical proofs. The amount of hardware, software, and energy you would have to expend to beat the other parties, race ahead of the transaction, double spend the money, mislead, if you will, fraudulently mislead the other parties in the network. They're using radical decentralization and these difficult mathematical proofs to prevent fraud and to prevent anyone from stealing. A 51% attack would allow for a stealing of transactions and stealing of funds. How much money and how much energy is being expended today to perform those cryptographic proofs for the Bitcoin network across the entire network, globally dispersed, open sourced? Apparently it's as high for one full Bitcoin as 2 full years of power use for an American household. On any given day, the Bitcoin network is expending the equivalent of the country of Ireland's energy to perform the Bitcoin consensus, as it's called, for transactions. Again, a race between what it costs me to do the calculations, all the hardware, software, and electricity, and the difficulty of the transaction. It's very difficult to beat that hash, to beat that proof. Today, over 40% of mining is concentrated in China. What had originally started as firms that acquired massive amounts of server and low-cost electricity, in many cases has moved to the utilities themselves in China performing mining activity. It is a...
The essence of the work that's being done when that electricity is being used, is it the validation of every transaction that happened in the blockchain prior to the existing one?
You have the compilation of the proof. So to your point, each block that's added to the chain adds to the difficulty, the hashing power, yes, that's required to break that. So can't go back and rewrite the record. This brings the issue of forking in. I won't go to that level of detail. So in effect, you have a golden source, a golden record. That's a tremendous insight. It's a tremendous insight, and it says a lot about, as I said, bringing together that software, the cryptography, and the distributed systems. When you step outside of cryptocurrencies and Bitcoin and Ethereum, much of the enthusiasm that exists in the corporate sector, starting with financial services, but now moving into the areas that have supply chains, into the government sector and elsewhere, comes out of 4 key components. So I've talked about that shared ledger. It's an append-only distributed system of record, unlike shared databases, append-only. Again, difficulty to go back and corrupt that record. Consensus. But in this case, consensus not being thousands of participants and nodes, but a small group of parties who have some reason to collaborate with one another, but high levels of concern that they have privacy around some of the record, agree in smaller groups that they can collaborate, and the benefits of this network in terms of efficiency and productivity gains, reductions in needs to reconcile between organizations, particularly true in financial services, take the friction out of the system. Do you have what you say you have? Did we agree? Is it good? That consensus can be a matter of simply attaining a majority and preserving a majority and understanding that players in the network are acting appropriately. Privacy around secure and authenticated transactions that are verifiable. And then the concept of smart contract, another lightning rod term that's used. I like to think of it as rules or business logic, if-then statements that take what would be business processes and relationships between parties and allow information to come in and out of the system and perform activities related to the assets or transactions represented on the system. So a shared ledger, consensus, the privacy, and some form of business logic that further enables this. Now, in the Ethereum world, that smart contract concept is core. Yes, the shared ledger, the record keeping is of interest, but if you are able to bring a decentralized group together and have them agree around something, it could be a project you might be working on here at university, where parties are agreeing that they'll pay out Ethereum cryptocurrencies to one another based on their contributions to a project, a joint project to be submitted at the end of the semester. And your relative contribution and payout is based on a verifiable record and software-enabled logic that says you contributed that, that's been verified, you get paid out. That might be an illustration that's a small one, but the idea is it's decentralized, it's autonomous, and it has some kind of corporate or governance function. The ambitions of the folks in the Ethereum community are quite literally to disrupt whole sectors of society. It's a little difficult to see. You may be able to turn and see in the back if you're closer to the back. But across sectors, whether certainly it's in finance and financial institutions, traditional capital markets and trade finance, payments, regulatory compliance, anti-money laundering, KYC rules, peer-to-peer transactions, insurance, corporates in the supply chain management area, governments. One of the areas that is tremendous interest is identity management. This is particularly of concern in developing world, as well as for refugees. There are quite a few folks in the blockchain community who are working on what they call self-sovereign identity. The idea that I own my identity, I own my data, I selectively share information, and there are verifiable claims that that's me. So when you go into the bar, you don't have to show a driver's license. They only need to know that you are of age. They don't need to know your eye color, the state, your height, none of that. Just that verifiable claim. The idea of a self-sovereign identity is that my economic self, as an actor, an employee, a student paying tuition, a consultant, in a sharing economy, in my financial life, as a depositor, a borrower, as a beneficiary or an investor, in my life as a patient in healthcare, almost from cradle to grave, that I could share my patient data, my patient record. And finally, as a citizen, I could have a self-sovereign identity and be in control, whether I'm a voter, I'm serving in the military, I am a benefactor of Social Security, that I'm in control of my information, I'm in control of my identity. This is an area of great push within the blockchain community more broadly. There are dozens and dozens of firms around the globe, whether they're organized as companies and LLCs or as foundations or just an independent group of developers that have gotten together, and their hunt and their desire is to take the identity and allow us to take control back of our identities from the big players. Those big players could be banks, they could be governments, they could be Facebook, Apple, Microsoft, and Amazon, FAMA, I guess it's known as. That's the big disruption potential. Disintermediate banks, disintermediate governments, disintermediate corporates. That's the techno-libertarian dream. Underneath that, there is tremendous opportunity to gain control, improve efficiency and productivity, and in other cases, ensure that compliant activity and behavior is occurring with the benefit of this registry and the proofs that sit behind it. Across sectors and also across aspects of the technology stack. So data storage, the Internet of Things, record management. These are all areas where blockchain is being explored. This world of sensors and IoT, as you walk about campus, the cameras, the apps on your mobile device, if you happen to have an implant that has a sensor in it, or you've gone through a biometric, all that information going back and forth between sensors and actuators or sensors and other systems could be mediated by blockchain. That's part of the dream as well. Machine to machine mediated, where blockchain is verifying the identity of the machines on either end, if you think about it, and the integrity of the data moving back and forth. This is another area of aggressive pursuit and interest by people who are looking way out over the horizon and saying, how might blockchain enable? Now, blockchain's not doing all this itself. Data analytics, machine learning, artificial intelligence, these are all part of that larger picture of a world enabled by IoT. But many of the most revolutionary thinkers in blockchain are looking at an IoT world and how can we trust it and how might it be mediated? And importantly, how can data move at machine speed? Intel is working with blockchain with an expectation that there will be billions and billions of devices and sensors that information will be mediated through, relying on blockchain. How would that manifest itself? Well, you can imagine being out in a very large acreage farm in the Midwest, remote irrigation, relying on weather patterns and the like. And if you have sensors throughout that field, then being able to provide the adequate water and fertilizer at the right times based on the real soil conditions and the real climate conditions. Once again, folks are certainly looking at sensors to enable that in analytics, but as well introducing blockchain in as a layer of assurance that the devices talking to one another are in fact doing so with integrity as defined by the machines. So that's that big picture. All of these opportunities come with challenges. And when you think about applications of blockchain and when you hear about what's being done in various industry sectors or otherwise, you want to look at use cases very closely and say, is that really something that blockchain is enabling? Is it giving me the lift? Is it providing something meaningful that otherwise a shared database wouldn't otherwise provide? There's some real tough questions that have to be asked of any use case that's presented. Whether the parties are relying on an intermediary today. Are they sharing information as transparently as they might? Would they have incentives, and what would those incentives be for them to share more information? Yet how can they be protected at the same time? How can we ensure that the chain of transactions is valid? How do we mediate and manage that? Each use case is a little bit different, and I'll come to that. As well, I'll talk about fundamental challenges in terms of the technology, regulatory challenges, and certainly there are geographic challenges. Data in particular personal data, as I was referring to it, does not freely move across borders. Here in the United States, we have protections around our personal data, but importantly, our health data through HIPAA. And in the EU, come another 2 or 3 months, going live is something called GDPR, which is a data protection regime that is extremely stringent and prohibitive of companies and other bodies retaining data long past the useful life or transmitting data across borders. So there are nettlesome issues for anyone involved in blockchain that is envisioning a broad solution, a global solution that involves personal data going across borders. There are such things as regulations. I developed this about 3 years ago as a way to try to explain to myself what was going on in finance. I came from finance, spent a better part of 2.5 decades working on Wall Street banking, and then for a firm here in the area that does investment processing and fund administration for large banking institutions and money managers. And I was looking at what was going on in Wall Street and in banking with blockchain, and I came up with this graphic. And the way to think about it is there's 4 dimensions across here, and they are relative. And if you can understand an industry sector, it might be in finance, it might be in some other industry, and break down what's going on around transactions between parties, you'll find they'll sort into 1 or 2 corners here. So in the lower left corner are very high transaction volumes, but relatively low time periods between deciding that a transaction is going to occur and then what's known as the clearing and the settlement of that transaction. Are the parties in good order? Do they in fact have the assets on either side of the transaction? And how long does it take then to clear and settle? A good example there in the lower left corner would be transactions on the New York Stock Exchange or the NASDAQ. Billions of shares traded each day, hundreds of millions of orders. The order and then the trade is the transaction. The way that the financial markets work in the United States, the time to clearing and settlement is 3 days. T, trade, plus 3. When I got in the business, it was trade plus T plus 5. The industry is moving to T plus 2. Huge investment in technology, lots of changes that need to be made to move processes and systems back to T plus 2. In theory, blockchain could enable the transaction clearing and settlement to occur all at the same time or near real time. Now, the industry could move there, but there is a lot of reason why it's sitting where it is and a lot of investment down in that area to move transactions in the billions a day. So if blockchain is to move into that space, you've got existing providers who have huge investments and are today able to demonstrate tremendous performance, lots of resilience, strong resilience to attacks, strong resilience to problems with their systems. So that lower left-hand corner, in finance, you can think of the equity markets. And in health insurance, you can think of claims processing. Insurance more broadly, claims processing would be an example where in effect you have large organizations, large utilities that are processing transactions in extremely high volumes on a daily basis. In the upper right-hand corner, now we're moving to longer timelines, days and weeks for a transaction to be consummated and then cleared and settled. The volumes are relatively small. The amount of data could be huge. The dollar value could be huge. Here we have derivatives instruments. So those of you who are taking finance classes, you'll recognize derivatives instruments can be quite complex. Oftentimes it's a custom deal. I might sell Brent crude out 12 months and buy against that the Japanese topics, the Japanese stock exchange index with another party. And we will, on a day-to-day basis, exchange cash and collateral to cover the movements in those two measurements, if you will. The topics is just a measurement of an index. It's not a thing, really, per se. But up in that upper right-hand corner for Wall Street are hundreds of millions of dollars often associated with one individual derivatives transaction. And regulators insist that banking institutions retain capital against the risk that's associated with those transactions. Counterparty risk. What if the other party doesn't pay? So one of the reasons why Wall Street is going so aggressively around blockchain and the ability to agree behind the scenes transactions that often take several weeks to clear and settle, and then the collateral, the continuous updating of the collateral, they're looking at blockchain and the enabling business logic or smart contracts because they'll be able to reduce the amount of capital they have to keep on their balance sheets. If I know that a derivative instrument is not going to fluctuate as much, and I multiply that across notional values on my balance sheet in the trillions of dollars, JP Morgan has, I think, over $20 trillion of derivatives instruments, notional value on its balance sheet. If it can demonstrate to the regulators that the risk profile has dropped significantly because the counterparty reliability and true-up is happening more frequently, then they could reduce the amount of capital they have to hold against that asset. And that holds across their balance sheet. It holds for their loan portfolios. It holds for more mundane securities that they may hold. That's why Wall Street's throwing so much money at this, because if they can reduce the capital and they can still earn the returns on the top side, they're going to improve their returns on equity. It is no surprise that Wall Street is working on this. This is not just about back office costs for Wall Street. And interestingly, as you look at the different players who have emerged, R3, if anyone's familiar with that, the work that JP Morgan is doing, they're in that upper right-hand corner. Highly complex transactions involving multiple parties, lots and lots of money associated with the transaction, and a latency that is in the weeks that could be reduced to days, or days that could be reduced to hours or minutes. In the lower left-hand corner, that's where payments is. That's where the equity exchanges are. Everyone's experimenting. Now, if you go across industry sectors, I've mentioned healthcare and claims processing. Similarly, you could come into any industry where there are a need for certifications or other attestations as to my identity and my background, or other things about a transaction or an asset that need to be verified that aren't per se about the asset, but about the parties involved. Those things tend to fall in that middle range along that barbell that I'm describing. My hands should be this way, I think. Right? In this middle range, a whole variety of use cases. So if you think about an industry sector, you think about supply chains, for example, extended supply chains that may involve fruits, vegetables, or at the other extreme, complex capital goods with elements that have been sourced from around the world, and you want to ensure that the metallurgic qualities of machine tooling are properly done. All those things around supply chain, pharmaceutical supply chains, they likewise are falling kind of in that middle range. The transaction volumes in any particular sector may be relatively large for that sector, but they certainly on the order of what we see in the equity markets. And it is nothing compared to what we will see if, in fact, sensors and IoT are talking to one another and enabled. It's not hard to see that this is occurring across industries. It's also not difficult to understand why people are as excited as they are across sectors. That said, there are significant challenges. One is business model. Fundamentally, we can solve a lot of technology problems, but can we get corporate managements, can we get universities, can we get governments to think differently about data, who owns data, what should be shared, what's proprietary? If it's not my data, but it might be proprietary information for my business, am I willing to share that information? And if I am sharing it with traditional competitors or other parties that are in my sector, what's the business model? How do I make money? What is the core of the business? We hear a lot about data being the future and us going into a digital world. What do those business models look like? Is it a revenue share? Is it a sharing of benefits on the back side in terms of cost savings? Can we eliminate opportunistic behavior? Can we, in fact, go to the world that Vitalik Buterin and others have suggested, completely decentralized autonomous corporations? Who mediates and governs the group that comes together and agrees? It's not just about computing power. Those commercial issues extend and are informed by, in many industries, legal and regulatory considerations. I've mentioned personal data and the boundaries and challenges around personal data. Likewise, in finance, there are substantial regulations, and they exist for good reason. Certainly those around risk capital are important, and we've learned very difficult lessons back in 2007 and 2008 in the mortgage-backed related crisis and the contagion effects that occurred from that. In healthcare, significant regulations, not just around personal data, but the safety, efficacy, and performance of pharmaceuticals and medical devices as they're associated with my health, whether it's diagnosis or therapy. Regulations that exist, not just speed bumps, if you will, but hardened lessons. Across sectors in manufacturing and other areas, in fact, right in this very building, the structural engineering is associated with standards and controls that have been decades, in fact, some cases centuries in the making. Basic understanding of structure and metal and the like. It's amazing as you go and you look into different industry sectors, the level of inspection, testing, and certification that goes on. Not just fire alarm systems, but whether or not the steel that crude is being carried in has corrosive protection qualities all through uniformly, based on engineering work that was done 50, 60, 70 years ago, now introducing new alloys and new strength. Almost every aspect of our society that you go through, you walk down that train line and think about it, there's some kind of standard that has been built into that, some kind of engineering standard that takes form and substance in legal contracts, in a regulatory sense and otherwise, safety obligations that pervade our society, and rightly so. So thinking about a machine-to-machine world, a world largely driven by data, we need to understand that the corpus and strength of what has been built up in human society, whether it's our institutions or the controls and standards that we have that allow us to go up and down a stairwell or onto a train line with some level of comfort, that they exist there for a reason. Blockchain can help enable those things. It is not supplanting those things. The technology itself is immature. The Ethereum community wants to move away from one form of mining to another. As I mentioned, large corporates are experimenting with private permissioned ledgers and chains, if you will. They're going to have to work out consensus mechanisms and hierarchies, if you will, reference architectures about who validates and who certifies, who notarizes. There's a lot of different terms, but it's largely about governance and what did we agree and who agreed it and to what extent can we rely on that agreement. These are all traditional governance issues, and technology will manifest whatever is agreed. Likewise, the communities themselves have a lot of disagreement among them, the open source communities. There are issues around code and code quality. The Ethereum community is moving very rapidly to encourage bounty-like open source challenges to code and identifying bugs. Bitcoin has a core developer community that's a bit closer. But certainly any open source initiatives, the Linux Foundation, another example, which is working hard to promote through its Hyperledger project, enterprises embracing blockchain itself, as well as looking for coders in an open source sense to go ahead and identify vulnerabilities and report those in. These communities are reliant on that kind of work. If I roll forward 3, 5, 10 years, we'll probably be in a world that is public and private blockchains. And at some level, they'll need to be interoperable, just as the internet became seamless for us. We went from intranets to a public internet. There'll be some level of integration and interoperability that have to occur. These are tough engineering problems to be sorted out. And importantly, there will be, within those regimes and those sub-ledgers, if you will, governance structures and code that need to be reconciled as well. So we are a long way from this being completely a blockchain-enabled world, but I can assure you that there are a lot of folks working in a lot of areas in discrete pockets that know they need to come together, and others that perhaps are less willing to work with others, but on the other hand, open to everyone contributing. It is, I think, a distillation of a lot of trends in society to say, why are traditional institutions the only place that things get decided? Why can't I make a contribution? There is a deep thread in this that is ideological and a larger push toward open source, understood more in a sociological sense than in a computing sense. So this is an opportunity for me to step back and talk a little bit about what we're doing at Spiritus. We have a team of 8 people over in Scotland right now, a full stack team. And we are working on what we call next generation service records for critical assets and infrastructure. Our initial focus is medical devices and equipment in hospital. They are often complex, connected, software enabled. They may have, in fact, got intelligence and algorithms associated with them, or they may be as mundane as beds and hoists that need to be in good order. They need to be sanitized. They need to be working properly mechanically, or people can be needlessly hurt, injured, have complications, or even die. When we started looking at medical devices, we realized that there was a very fragmented chain of custody, if you will, from the manufacturer and distributor into a health system, a lack of visibility and transparency about whether a device or a piece of equipment was in good order, and disturbingly, when actual recalls are issued for that implantable defibrillator that has a software bug, or an infusion pump that is delivering pain medication in a way that doesn't truly reflect the meter reading on the sensor, or a battery is being drained needlessly, or God forbid, something as what may sound as simple as a rail on a bed that's not up to snuff for a bariatric bed, but was in fact intended for a community bed in home, and somebody ending up falling from the bed and getting their neck pinched and wrenched in the bed. These are the kinds of things that happen with medical devices and equipment, and unfortunately it takes months and sometimes years for manufacturers to recognize there's a safety issue, and then it takes months for the notifications to make their way to the various parties, and only to know in a specific ward in use is this particular infusion pump with this product code on it, with this battery that most recently was upgraded at this point. This is horribly fragmented and broken, and we've stepped into this area to say, how might we bring together all the parties around the chain of custody of a medical device or equipment, ensure that inspection, testing, and certification has been performed timely, that maintenance and repair has been performed in line with the service guide, even if it's a third party that's come in and done that work, that if there is a corrective action, a recall, or a safety alert, that it's been acted on, that attestations associated with artifacts that demonstrate that work has been done are associated with that device, and accompany it to the point where it's decommissioned and disposed and recycled. One of the things we've learned is that there's a huge market in the developing world for infusion pumps and ventilators and endoscopic equipment. That equipment comes out of hospitals in the developed world. Is that equipment in good order? How do you know? Is it past its service life? It's auctioned. No liability claimed by the auctioneer. Pay cash on the barrel. That's unacceptable to me. I need to know and understand from the time that a device is put into use, through its useful life, with one patient for years if it's implantable, or through its life with hundreds and hundreds of patients, and upon a disposal and resale, that it's in good order. And that's the vision that we started pursuing. What we found was that this problem of fragmentation during the operating life of an asset that can affect people's safety, security, and the environment is equally broken. It's broken in energy, offshore oil and gas. It's broken in power. It's broken in water treatment. So our business now is focused on next generation service records for critical assets and infrastructure and facilities. We're working with partners not only in Scotland, but with firms that develop and distribute field service software for that on-site inspector that's doing the work, integrating our application through APIs with their application. I don't want to build field service management software. I don't want to build asset management maintenance software. I want to integrate it with it. Around governance, risk, and compliance for those inspection and testing firms, we're going to integrate with their quality management systems or their governance, risk, and compliance systems. Think of it as an application layer. Will be agnostic to the blockchain, but you'll be able to prove and verify that the right actions were taken at the right time and by whom and with what artifacts to associate with it. That's where I've taken what I've learned and distilled from my experience with blockchain over the last 3.5 years. I'm firmly convinced that it will make its way through many aspects of our society, and I'm committed to have it be in an area where it directly affects people's well-being. For those of you who are looking to pursue careers in finance or in other industry sectors where you're touching transactions in finance, I encourage you to learn as much as you can. This will become part of the fabric of almost every industry, there's no question. For those of you who are interested in the public sector, government, or working in universities, likewise, elements of identity and certification, validation around taking of courses and curriculum. Underneath the covers, blockchain is likely to be prevalent and apparent in those sectors. I don't see a lot of smiles. No revolution. It is astonishing. Anyone have any questions? Anyone long Bitcoin? Want to admit it? Anyone own Ethereum or doing any mining? There you go, under your desk, right? There you go, go ahead. Right? Yeah.
Early on in this environment with growth being as exponential as it is, capital allocation is really important, and more so is opportunity cost, right?
Mm-hmm.
So like you were saying earlier on with the Internet of Things, it's kind of longer term horizons for investments like IOTA and things like that.
Yes, yep.
How are you managing where you put your money in terms of, what is foreseeable in the near future versus, more long-term projects?
All right, would you like me to distinguish between investing through IOTA, for example, in projects or what we're doing with our business? I have two answers.
Both.
Okay, we'll start with my business. I absolutely envision a world where it'll be machine-to-machine, sensor-enabled, that yes, in maintenance, predictive maintenance is a big thing, but it's not affordable, and a lot of legacy assets, beds, hoists, other equipment, won't have sensors on them. And if they do, the best thing they've got is maybe a barcode that says, or an inspection note with them. So there's a legacy world that for a very long time we won't be able to afford to move to sensor-enabled tracking and the like. On the other hand, there are problems with IoT itself and the security at the edge that blockchain won't resolve. I just had a conversation on my way over here with the Chief Information Security Officer of a leading health system in Indiana. He's actually a Philly guy. Just moved out to Indiana 18 months ago, went to Temple. And he was chewing my ear off about IoT in hospitals and how far we are from being able to rely at that level and at that layer. So this is an important point. There's a tendency to wave pixie dust on things and say blockchain. when in fact the solution's not blockchain and the problems aren't rooted in blockchain either, right? So particularly with IoT, that's of concern. So is blockchain going to actually enable the solution? What about the legacy assets? A water treatment facility in a community around here is very poorly funded, relatively speaking, and itself quite vulnerable and not heavily invested in. Yet, to the extent you can put sensors and other information, into the inspection and testing process, whether you're sampling water or refuse flows, blockchain can help with that inspection and verification, right? So there's a physical world today that's just plain kludgy, fragmented, and inefficient that blockchain can enable, and then there's that machine-to-machine world down the road. So when you step out and you look at decentralized autonomous corporations and the ICOs associated with trying to tackle some of these problems, then you have to get to much more basic issues. Having too much money is not a good thing if you're a venture, right? You need to be parsimonious and you need to make choices. The other thing is the developer community. I might have mentioned it during the technology discussion. There are not a lot of people that have the in-depth blockchain familiarity. Then again, the technology needs to be hardened. So do you have the cryptographers? Do you have the distributed systems analysts? Do you understand how you're going to manage a decentralized system and the topology of the networks you're creating? These networks are going to be emergent and interoperable, and they're going to have behavior that's characteristic. The other thing to know and understand is coming into this area, and not surprisingly, are the big IT players. Microsoft and IBM are creating blockchain as a service. I like to call it the wraparound. Underneath, they're going to give you their cloud solution, which is secure, data hardened, cyber resilient, disaster recovery, all that good stuff. They're going to be agnostic to blockchain protocols, so you can plug and play as you choose. Click a button and you can enable networks, if you will, and nodes, and provision those nodes around some reference architecture. And then over the top, software developer kits and other things to enable the developers to work with it. They want to do this wraparound. And in all likelihood, they'll have the hardware and firepower, if you will, financially, to stand up and be the blockchain operators underneath. As a consequence, what I would suggest is, unless you really core want to work on protocols, focus on the applications. That's what we've tried to do. Focus on an application, a problem that blockchain can help enable a solution to, but is just a part of the picture up at the application layer. Remain agnostic to what's going on underneath. Be able, through APIs or otherwise, to connect back down to the registry. Is that helpful? Yep. And as with anything, take a portfolio approach.
Is blockchain then an ecosystem upon which the apps get built?
They can be. Blockchain, with a small b, diverse, yeah. You're going to have to make choices. We're going to be making choices in the Hyperledger framework between Fabric, which has grown out of the financial services community, but certainly is becoming general purpose, and Sawtooth Lake, that's Intel's. Intel has designed it specifically with billions of transactions in mind around IoT. Whether the underlying hardware, their chip, is up to snuff is a question. The argument is that chip has a secure, trusted execution environment. I think they had an issue a few weeks ago. I'm not sure about the security of their chips and the work there. But there are, beyond Intel, others that feel that you have to get it all the way down to the hardware level. As a business person, I look at that and say, well, that's great, but those chips have to be on servers in countries where I'm going to be operating because I can't move the data. So if it's secure, that's great, but if I can't move the data across borders and I don't have those servers in the country I'm operating in, it doesn't do me any good. There are path-dependent decisions you're going to have to make. Other questions? Non-technical, more business-oriented? Yeah.
Yeah, kind of a business-oriented question.
Yeah.
So, one of the main uses of blockchain is really in cryptocurrencies, and with things like Bitcoin, it's very volatile right now.
Yeah.
And I know there's a small number of stores that have Bitcoin ATMs or will accept Bitcoin as a form of payment.
Right.
But I really think that its volatility will kind of prevent it from becoming a mainstream accepted currency. How do you see them like kind of solving that problem?
It's a great critique. If a merchant can't rely, drugstore, $15 transactions, it's 3 or 4 items, can't ensure they don't have a foreign exchange risk, if you will, then it's not going to arrive at general use for payments. So unfortunately, and the fervor was extraordinary this summer, there are a lot of people that have invested in the ICOs based on the Ethereum protocol or Bitcoin that are merely involved in speculation. I started my career on Wall Street, and I always had this barometer. If so-and-so is buying something, it's probably a top. If so-and-so is asking about something, it's probably the top of the market. And it used to be if a taxi driver knew about something, you knew you were probably at the top of the market. And I had somebody recently who's completely not in the business and not in finance at all ask me about buying Ripple. And I thought, that's a top. And it was the top. Bitcoin had topped at 20,000, Ethereum was up around 1,400, and Ripple was $3.50 or $4. He called the top. I should have gone and sold short if I could, but that's part of the problem. One of the reasons they're so volatile is the bid and offer, if you will. There's no what we used to call no size on the spread. There's no size on either side. What's interesting is with the introduction of futures, you are actually starting to get an other side to the trade, and that started to dampen the effects, and you had that blow-off. The problem that Bitcoin faces, and Ethereum as well, is the slow transaction speeds and the exchanges themselves and the wallets being bottlenecks. If there's a fire declared in this room, which exit are you going to? Right? Have you already decided that? You better have decided that if you're buying Bitcoin and cryptocurrencies. In fact, you better be bleeding the money out now as best you can, because they cannot handle the volume if everyone is rushing to that door. And that's a fundamental problem in the cryptocurrency markets, not readily to be addressed. Now, there are folks in the Bitcoin community and otherwise that are starting to look at custody. So remember I mentioned the keys? Who helps protect the custody of those keys? Who's the fiduciary that's going to take on the burden and responsibility of protecting my keys? Today, the cash and securities associated with my Schwab account are protected by Schwab stepping up as a fiduciary, as a banking institution, to stand behind that, with the capital behind that. Bank of New York Mellon and State Street and Citigroup all have large custody, global custody businesses that have been built up over decades that provide assurance to investors on either side of a transaction, or certainly for me as a holder of an asset, that it's going to be safe, literally in a vault previously, now digitally, right? Folks in the blockchain and Bitcoin community, the cryptocurrency community, now recognize that there may need to be some form of custody. There's a firm called BitTrust that bought into an entity yesterday. And the folks out at Blockstream and some of the other firms out in Silicon Valley are starting to look at what they call smart custody. And as I've spoken with them, I've had to say, there's these legal issues, there's regulatory issues, there's capital issues. You're not running away from all this stuff. You're not going to show a regulator a bit of math and they're going to say that's good. That's okay with Susan's mother in Cleveland. She can feel comfortable with that at 80-some years of age, right? So this divide and this problem, what's happening is what's growing up in the cryptocurrency community are the same kinds of structures and support and protections that we have in the traditional financial world. And that will help to reduce volatility. But back to your question, very, very key point. If I can't depend from moment to moment that the value, that store of value is there for a simple transaction, it won't gain wide use for payments. Yeah?
So you talked about a correction in the market. I think last month you were at like 230 billion market cap, and we've had like a near 50% correction.
Yeah.
Do you attribute that to the CME futures or CBOE futures having their expiration dates as of recent? Chinese, the Lunar New Year, South Korean regulations. What do
as with anything in markets, and I went through the '87 crash, by the way, with E.F. Hutton, lost my job. I went through 2008, was dizzy day to day. So I've been through a few, and some of this gray hair is from that. There are a variety of factors, and in retrospect, you can go and point back. But the fact that you have large institutional players that trust that the Goldman Sachs and the JP Morgans have been modeling and investigating how the cryptocurrencies have been behaving, that they have robust analytics and sophisticated models that they have been running against those markets, notwithstanding whatever public statements are made. Behind the scenes, they have been putting them through, sort of a surgical inspection to understand the correlations in the behavior, understand the frictions. Why do I think that? Because they've done it outside of traditional securities. They've done it with all kinds of things that we would not consider to be assets, and found markets that they could create and analyze the behavior and gotten on the other side of the trade. That's how Goldman Sachs got long uranium cake and ended up owning, petroleum reserves, right? Because they know and understand. So to your question, yes, I believe that the involvement of the large institutional players, whether by virtue of the futures or their actual trading of their proprietary desks, or the work they're doing and the investments they're making in some of the startups, they have tremendous insight, and that's going to help to reduce the volatility. Now, Bitcoin holds itself apart because that core community of developers is holding fast around the supply, right? And now they're going to rely on the Lightning Network, some of them, to improve transaction speeds, right? So the fissures in the Bitcoin community and yet the inertia are a strength. And the more time you spend with the crypto maximalists and the Bitcoin maximalists, the more they point to that stability. The best thing that could happen for everyone's stake is for things to settle down, and that seems to be happening. Yep. This is not investment advice. Yeah.
Question about the work you're doing with Spiritus.
Yeah.
So the medical device manufacturers, the hospital systems, the doctors, the patients, everyone has a bit of a different vested interest in the product. Who is the target customer in that chain? Seeing as kind of everyone has a different focus.
Point of view. It's a great question, because we started thinking the manufacturers would have a primary interest. Clearly, there's evidence of litigation costing the billions around metal on metal hip implants, now issues with pelvic mesh and a variety of issues. It's the health systems that are Johnny on the spot. Here in the United States, it used to be that a health system could externalize 80% of the costs of incidents and adverse events. That's no longer the case as we move to value-based care. One of the reasons we're in Scotland with the NHS is they are the payer and the provider. They are on the hook. The government's reputation is on the hook. And that's actually where the fragmentation manifests itself. The other point is that the FDA and the EU regulators have moved to harmonize regulation. So there is something called a unique device identifier now that naively is going to be associated with a medical device. It doesn't nearly do enough. But regulators are agreeing that manufacturers must assign a unique device identifier to the device. So that helps with some of that fragmentation. What's important and of insight is the other side of the equation is a stronger insistence on post-market surveillance and adverse event management being continuous. And in the EU, the obligation to monitor post-market events and manage them is also not just on the manufacturer, it's on the distributor as well and the health system. So what's happened is there's sort of this knock-on, knock-up effect to the distributor, and in many cases the distributor also acts as a certified maintenance and repair provider and inspection and testing firm. So they're kind of, it's a knotted up world, and I believe that we can weave a cloth that allows the parties to share the information that's necessary.
Right. To that extent, it sounds like some of them are, at least in the UK, it sounds like they're in alignment with the shared liability. Where here it's a little bit different.
That's why I'm in Scotland. And I'll probably be in Canada next, right? So, Great. Any other questions? Anybody, feel free to leave, anybody. Yeah.
I can visualize like this monitoring of the machines. But I'm having trouble visualizing. I went to another blockchain talk, and they were talking about if I'm going to eat a banana, and that banana makes me sick, and it's got salmonella,
Right.
the blockchain is going to tell you what farm in South America grew that banana and trace it all through the chain and make sure nobody else gets sick. How does that work?
It is true that, that if all parties are involved, you'd be able to verify back.
Yeah.
To assume that the latency time, you know, between you ending up with E. coli or something like that is, what does that require? It requires a huge amount of data and data analytics and machine learning, and then a robust messaging system. And unfortunately, as I would understand it, safety regulators and authorities that would intervene. Look,
Farther out than what we're doing.
just a little, yeah. I'm worried about, no, literally, you can look at these safety notices and you can see there's a recall involving an infusion pump. It involves 30 different departments, 10 different types of personnel, and there are hundreds of them in the hospital. And you walk in the hospital and you bump into them in the hallway. And then there are also people who hold on to beds and things in their ward because they don't want to give them up. They don't even know where they are. They go missing out of the hospital to a community or to a home. It's unacceptably broken, and it's not enough to put tags on them, right? I need to know that mattress was cleaned. I need to know that that surgical instrument still can be used. Other questions? Yeah.
A lot of people, in looking to value crypto assets, they relate it to discounted cash flows, and they do that by using an exchange, which is from like Forex to evaluate the wealth of a nation, right? And it says monetary base of a nation times the velocity of how many times a crypto asset is turned over, equals the basket price of goods times the basket quantity of those goods, right? And that's what they're trying to do to evaluate the prices. But the problem that they're having is they're not able to accurately forecast the velocity or how many times the crypto asset will be turned over, getting to utilization, which we talked about earlier.
Yeah.
How are you guys evaluating, which assets are actually being used versus what are just lottery tickets that people are holding on to in the back pocket?
I'm going to sound like a real cynic when it comes to monetary policy, but in my own lifetime, the base around which monetary policy, the levers that have been used, have changed so dramatically in the understanding of macroeconomics. To take the existing understanding of macroeconomics and monetary policy and then overlay it and do some discounted cash flows, I just think it's a silly exercise. We can't trust the data in the ways that we try to manipulate the developed world economies. Why would this make sense? And it's those countries where cryptocurrency adoption looks to be the highest for utilitarian reasons, right? The government it can't be trusted, and they need some mechanism of exchange, right? So to be clear, we're not doing anything with tokenization and ICOs ourselves. We're self-funded. We're self-funded. Yeah.
Given its ambitions to be integrated in our lives at every level, how is blockchain endeavoring as an industry to offset its carbon footprint? It takes energy to run Ireland as it does to run blockchain for a day. How do you upsize that? How is it scalable?
That doesn't scale, you're right. Ethereum wants to move proof of stake, so it's reducing the footprint. The private chains that I mentioned have much lower footprints. They're not relying on radical distribution like that. They are relying on cryptographic proofs, however, so there is a cost-benefit analysis to the economics of that versus other alternatives in your system.
Okay, that's all we have time for. Thank you all. Thank you, Susan.
Thank you.
Have a great weekend.